Colombia, a nation celebrated for its vibrant culture, breathtaking landscapes, and resilient spirit, finds itself grappling with a sobering reality: a slowing economy. Once a beacon of economic promise in Latin America, Colombia is now navigating a complex web of challenges that threaten to undermine its hard-won progress. From dwindling economic growth to rising unemployment and soaring inflation, the warning signs are flashing red, demanding attention and decisive action. Understanding the magnitude of this economic slowdown requires delving into the key indicators that paint a stark picture of the challenges ahead. This essay will explore the multifaceted factors contributing to Colombia's economic deceleration. We will examine the decline in GDP growth, the persistence of high unemployment and underemployment, the surge in inflation, and the mounting public debt burden. Furthermore, we will analyze the deep-rooted structural issues plaguing the Colombian economy, including political instability, commodity dependence, low productivity, social inequality, and environmental concerns. By understanding these interconnected challenges, we can begin to envision a path towards a more sustainable and prosperous future for Colombia. The gross domestic product, or GDP, a measure of a country's overall economic output, serves as a crucial barometer of economic health. In Colombia's case, the GDP growth rate has been on a downward trajectory, signaling a worrying trend. While the Colombian economy experienced robust growth in the early 2010s, fueled by favorable commodity prices and increased foreign investment, this growth has slowed considerably in recent years. The decline in GDP growth can be attributed to a confluence of factors, both internal and external. Globally, economic uncertainty, driven by geopolitical tensions and trade wars, has cast a long shadow on emerging markets like Colombia. Domestically, political instability, social unrest, and the lingering effects of the COVID-19 pandemic have further dampened economic activity. The decline in GDP growth has a ripple effect throughout the economy, impacting job creation, investment, and overall living standards. Addressing this slowdown requires a multi-pronged approach that tackles both the immediate challenges and the underlying structural weaknesses of the Colombian economy. One of the most concerning consequences of Colombia's economic slowdown is the persistence of high unemployment and underemployment. While official unemployment figures have shown some improvement, they mask a deeper problem. A significant portion of the population is either unemployed or trapped in precarious, low-paying jobs. This phenomenon, known as underemployment, is particularly prevalent in the informal sector, which accounts for a large share of employment in Colombia. The lack of quality job opportunities has far-reaching implications for Colombian society. It perpetuates poverty, fuels inequality, and undermines social mobility. Moreover, it deprives a significant portion of the population from reaching their full potential, hindering economic growth and development. Addressing this challenge requires a comprehensive strategy that focuses on creating more and better jobs, particularly in sectors with high growth potential. This includes investing in education and skills development, promoting entrepreneurship and innovation, and creating a more favorable business environment to attract investment and create employment opportunities. Section 4. The price of instability, inflation, and its bite. Inflation, the rate at which prices for goods and services rise over time, has emerged as a major concern for the Colombian economy. After years of relative price stability, inflation has surged in recent months, eroding purchasing power and putting a strain on household budgets. This surge in inflation can be attributed to a combination of factors, including supply chain disruptions, rising energy prices, and increased consumer demand following the easing of pandemic-related restrictions. The Central Bank of Colombia, like many central banks around the world, has responded to rising inflation by raising interest rates. However, this delicate balancing act aims to curb inflation without stifling economic growth. High inflation has a disproportionate impact on low-income households, who spend a larger proportion of their income on essential goods and services. It also creates uncertainty for businesses, making it more difficult to plan for the future and invest. Controlling inflation is essential for ensuring macroeconomic stability and fostering sustainable economic growth. Section 5. A delicate balancing act, navigating interest rates. In response to the surge in inflation, the Central Bank of Colombia has embarked on a path of raising interest rates. This monetary policy tool aims to curb inflation by making it more expensive to borrow money, thereby cooling down economic activity. While raising interest rates can be effective in taming inflation, It also comes with potential downsides. Higher interest rates can discourage investment, slow down economic growth, and potentially lead to job losses. The central bank faces the delicate task of finding the right balance between controlling inflation and supporting economic growth. This requires careful monitoring of economic data, anticipating future trends, and making timely and well-calibrated policy adjustments. The effectiveness of interest rate policy also depends on other factors, such as government spending, fiscal policies, and global economic conditions. Section 6. Drowning in debt, the public debt burden. Another challenge looming large over the Colombian economy is the rising level of public debt. Public debt, the total amount of money owed by the government to domestic and foreign creditors, has been on an upward trajectory in recent years. This is partly due to the government's response to the COVID-19 pandemic, which necessitated increased spending on healthcare, social programs, and economic stimulus measures. While these measures were necessary to mitigate the impact of the pandemic, they have also contributed to a widening fiscal deficit and a growing debt burden. A high level of public debt can have several negative consequences for the economy. It can lead to higher interest payments, crowding out other essential government spending on education, healthcare, and infrastructure. It can also make the country more vulnerable to external shocks, such as a sudden increase in global interest rates or a decline in investor confidence. Addressing the rising public debt requires a combination of measures, including fiscal consolidation, structural reforms to boost economic growth, and improved debt management practices.